Stocks or real estate, the age-old question. Which one is better? The answer might surprise you, so hang in there. We're going to go through it right now.
Hey, my name is Eric Bowen, founder of IdealREI.com, and I'm here to help you achieve financial independence through real estate investing so that you can live the life that you deserve.
So in order to compare stocks versus real estate, we really need to look at all the different sources of income, the way that they earn money, and the benefits of each type. And so I've really broken it down, stocks versus real estate right here, using this acronym, IDEAL. Income, depreciation, equity paydown, appreciation, and leverage. And these are the different benefits that you can get for either type. And so let's just go over it. So income for stocks is dividends. And on the S&P 500, it fluctuates. It really varies year to year, but it's around 2%. Real estate income is different. That is from rental income generally. And that for unleveraged, if you own it in total cash, let's just say around 6%. And it really depends. If you're in a core downtown market like a Boston or a Los Angeles, that's going to be like 4%. But if you get outside of the major core areas, you can easily get 5, 6, 7, or even 8%. And that's usually analyzed or determined with what's called the capitalization rates, which is in a different video. But that's just the total income that you're going to get, your profit after all expenses if you have no loans. And so 6% is totally doable even in a hot market like now. If it's leveraged, if you have 75 or 80% leverage, you can easily get 10% or more on the cash that you've invested. That's because you have the leverage. Depreciation. So real estate has depreciation where you can offset most of your income is offset through depreciation, whereas stocks doesn't have that. So when you sell your stock or you make your earnings, you got to pay taxes on it. With depreciation, you can offset most, if not all, and sometimes more than what you've actually earned. So if you earn $10,000, generally you're going to have around $10,000 in depreciation. It depends on the asset. It really depends on a number of things. But you can definitely offset most, if not all, of your income. So your tax burden here is a lot less. And so if your capital gains are 15%, that's a savings of 15% right away for real estate that stocks doesn't have, or stocks do not have. And you can defer that all the way up until you sell the asset, which case then you will get taxed on all of it, but between now and then, you've got deferred taxes for that entire time. And when you do sell, you can do a 1031 exchange, so you might defer it even further. But so this one definitely wins in this category. Equity paydown. So if you have a non-leveraged asset, there's obviously no equity pay down because you're not paying down a mortgage. But if there is leverage, you will pay down here, whereas in stocks, there's no equity pay down. Even if you do leverage or whatever, it's interest only, and so there's no equity pay down. So every month, you're not increasing your equity position. So real estate wins here. Appreciation. So stocks earn most of their value through appreciation. Every year, as these go up, your stocks go up in value, most of the earnings is in appreciation. Now, the average S&P returns somewhere between 7 and 8%. And it depends on what study or what time frame you're really looking at. So I'm not going to, it's somewhere around 5 to 6%. Because the overall return's around 7 or 8% for the S&P 500. Real estate is going to be a little bit less. It's going to be around 2% per year. It really depends. It could be more, it could be less. It really depends on your market. It's broad generalization right here. But if you are leveraged, if you're leveraged at 75%, that's gonna multiply because your return on your investment is gonna be, you're gonna capture the whole return and invest a lot less. So that's probably closer to around 8%. And leverage. Now you can leverage stocks, but most people do not leverage their stocks. Most people don't have the ability to leverage, and if you do, it's short-term debt, high interest rate. You can get capital calls if the values go down significantly. They can sell the stocks right out from underneath you, and there's a low loan to value, maybe around 50% or less for many people. Now, real estate has one of the most well-established capital markets in the planet, especially in the U.S. Long term, you can do, if it's commercial, you can do 10, 15-year notes. If it's residential, you can get 30-year loans. Low interest rates. Interest rates are incredibly low on real estate, in the 4s on commercial and the 5s on smaller property. Cannot be called. So as long as your property is you're paying your bills, it generally cannot be called. There's some caveats to that for larger stuff, but it can't be called generally, and there's a high loan to value. generally between 70 and 80% loan to value for rental property. And if it's a residential property, 1 to 4 units, you can get up to about 97% loan to value on that. That's obviously the higher your loan, the more risk there is. So in general, real estate can earn 15, 18%. And most of it is untaxed or deferred taxes. Stocks earn around 8%. If you leverage it, you can get more. If you're doing well, if the market's going up, it has a lot higher risk. So even if you're earning 10 or 12%, you're doing really well. Average, mind you, not. Some years could be 18%, other years could be negative 18%, whatever. But you're going to average somewhere between 8 and 10%, and that's going to be all taxable, whereas real estate's not. So I would have to say in the real estate versus stock comparison, I would say real estate wins. Now, I'm not saying you should invest all of your money in real estate, because it's good to diversify, because real estate can have crashes as well, just like stocks can. But I'd say in general, real estate is a much higher returning asset than stocks are. And so that's my analysis on it. Now, what do you think? Go ahead and comment below.